Taxes are going to be one of the biggest expenses of your entire life. Bigger than your car. Possibly bigger than your groceries. And while you absolutely have to pay them, most Australians are handing the ATO more money than they legally need to. Not because they are doing anything wrong, because nobody ever sat them down and explained what they are actually allowed to do. So in this video, we are going to fix that. Here are the strategies the ATO allows every Australian to use right now to legally reduce their tax bill and keep more of what they actually earn. But before we get into the strategies, you need to understand one thing about how Australian tax actually works. Because a lot of people get this wrong, and that misunderstanding costs them money. How Australian tax brackets actually work. Australia uses a progressive tax system. The more you earn, the higher the rate. But here is the part that trips people up. You do not pay the higher rate on all your income. You only pay it on the portion that falls into that bracket. For the 2025-26 financial year, Australian residents pay 0% on the first $18. $200 they earn that is the tax-free threshold. Then 16% on income between $18,201 and $45,000. Then 30% on income between $45,135. Then 37% between $135,001 and $190,000. And 45% on anything above $190,000. On top of all of that, most Australians also pay a 2% Medicare levy. So, on a $100,000 salary, your effective tax rate, the actual percentage of your total income going to the ATO including Medicare, works out to around 23%. Not 30%. That higher rate only hits the top slice. And this matters because there is a myth that trips up a lot of Australians. The idea that a pay rise can push you into a higher bracket and leave you worse off. It cannot happen. A pay rise that takes you above $45,000 makes you better off. The extra dollars are taxed at 30%, not your entire income. You cannot earn more and end up with less after-tax income because of bracket creep. Always take the raise, mate. One important update to flag. From 1 July 2026, the 16% rate drops to 15%. And from 1 July 2027, it drops again to 14%. For anyone earning above $45,000, that first cut saves $268 a year. Automatically, your employer updates your withholding from 1 July, and it just happens. Small but real. Now the strategies. Strategy 1. Salary sacrifice into super. This is the single most powerful tax strategy available to everyday Australians, and most people are barely using it. Here is how it works. Instead of your full salary landing in your bank account and getting taxed at your marginal rate, you ask your employer to redirect part of it directly into your superannuation before income tax is calculated. That money goes into super and gets taxed at just 15%. If you earn between $45,000 and $135,000, your marginal rate is 30%. By salary sacrificing, you are moving money out of that 30% environment and into a 15% environment. That is a real difference on every dollar you shift. Let us put real numbers on it. A nurse from Perth earning $90,000 who decides to salary sacrifice $10,000 into super saves $1,500 in tax every single year just by filling in a form. Without salary sacrificing, that $10,000 gets taxed at 30%, $3,000 to the ATO, $7,000 in her pocket. With salary sacrificing, the same $10,000 lands in super taxed at 15%, only $1,500 to the ATO, $8,500 working for her retirement. The concessional contributions cap for 2025-26 is $30,000, and that includes your employer's compulsory 12% super guarantee contributions. From 1 July 2026, that cap rises to $32,500. So depending on what your employer puts in, there is usually room to add more before hitting that cap. To get started, just speak to your HR or payroll team. Most workplaces handle it with a simple form. If you are self-employed, you can make personal contributions directly to your super fund and claim a deduction. Just make sure you lodge a notice of intent to claim with your fund before you submit your tax return. The only catch is you cannot access that money until around age 60. But if you were planning to invest it for the long term anyway, you are just doing it in a much lower tax environment. That is not a sacrifice. That is a strategy. Strategy 2. Every work-related deduction you are entitled to. The ATO has a page on their website called Deductions You Can Claim. Most Australians have never looked at it. And they are leaving money on the table every single year. The golden rule is simple. If you spent money to do your job and your employer did not pay you back for it, there is a good chance you can claim it. Tools and equipment, professional development courses, industry memberships, work-related subscriptions, union fees, uniforms with a logo, protective gear. None of this is complicated. Most of it just requires a receipt and a bit of organization. The big one right now is working from home. The ATO's fixed rate method for 2025-26 lets you claim 70 cents for every hour you work from home. That single rate covers your electricity, gas, internet, phone, stationery, and computer consumables. Someone working from home 2 or 3 days a week across a full year can add up to a genuinely meaningful deduction from that single rule alone. If you drive for work, not your commute, but actual work travel between sites, to client visits, or to pick up supplies, you can claim 88 cents per kilometre using the cents per kilometre method, up to 5,000 business kilometres a year. That is a potential deduction of $4,400 if you legitimately drive that far for work. And from the 2026-27 financial year, the government is rolling out a new $1,000 instant tax deduction for work-related expenses. That means you will be able to claim a flat $1,000 without needing receipts. If your actual work expenses are usually under $1,000, this simplifies your return significantly. The key to all of this is one habit. Keep records throughout the year. Download the ATO app on your phone. Inside it, there is a feature called My Deductions, where you can photograph receipts and log work-related expenses as they happen. 20 seconds per receipt. Everything's sitting there waiting when July comes around. Strategy 3. Understand the capital gains tax rules before you press sell. If you have any investments outside of super shares, ETFs, crypto, property, this one matters a lot. And many Australians are leaving real money behind simply by not knowing these rules. When you sell an investment at a profit, that gain gets added to your taxable income for that year and taxed at your marginal rate. But if you hold the investment for more than 12 months before selling, you currently receive a 50% CG discount. Only half the gain counts as taxable income. Real numbers. You bought shares, and they have grown by $10,000. If you sell after 10 months, the full $10,000 is added to your income and taxed at your marginal rate. If you wait past the 12-month mark, only $5,000 counts as taxable income. Same shares, same profit, half the tax just from understanding one rule and being patient. And if you have other investments sitting at a loss, selling those in the same financial year lets you offset that loss against your gains before the discount even applies. This strategy is called tax loss harvesting. It is completely legal. Just do not sell a losing investment and immediately buy back the same thing that is called a wash sale, and the ATO does not accept it. From 1 July 2027, the 50% CG discount is being replaced with cost-based indexation and a new minimum 30% tax on real capital gains. The strategy of using losses to offset gains still works under the new rules. The calculation just changes. Check the ATO website for the latest once those rules take effect. Strategy 4. Private health insurance if you earn over $101,000. This one catches a lot of Australians by surprise at tax time. The Medicare levy surcharge threshold for 2025-26 is $101,000 for singles and $202,000 for couples and families. If your income exceeds this and you do not hold eligible private hospital cover, you pay an extra 1 to 1.5% of your total income straight to the ATO on top of the standard 2% Medicare levy. On a $110,000 salary, that is over $1,000 in extra tax. Every year. just for not having the right cover. Here is the part that makes this an easy call for many people. A basic private hospital cover policy often costs less than the surcharge itself. You end up paying less overall, and you actually get health cover out of it. A couple of things to check. Extras only cover dental, optical. Physio does not count. You need actual private patient hospital cover, and the excess on your policy needs to be $750 or less for singles and $1,500 or less for families. From 2026-27, the threshold rises to $105,000 for singles and $210,000 for families. Jump onto a health insurance comparison website, check whether you are above the threshold, and run the numbers. For most Australians earning above $101,000 without hospital cover right now, the answer is clear. Strategy 5. Get a good tax accountant. The ATO is not going to ring you up and remind you what you are allowed to claim. That is on you. And every year you do not claim what you are legally entitled to, that money just disappears. If you paid a tax accountant to prepare your return this year, that fee is actually tax deductible. So is any software you use to track your investments and calculate capital gains. A decent tax accountant costs a few $100s. For most Australians, they save more than they cost, especially if you have investments, a side hustle, or you work from home. And their fee comes straight off your taxable income the following year. The honest takeaway is this: tax does not have to be complicated. Understand how your brackets work. Make the most of your super. Claim what you are entitled to. Know the CGT rules before you sell. And if you earn well, make sure your health insurance situation is sorted before 30 June. None of this needs a law degree. It just needs you to know these things exist and actually do something about it. Subscribe to MoneyMate Australia for more practical money breakdowns built for everyday Australians. And comment below with the word refund if you watched all the way through it. Tells me this landed and helps more Australians find the channel.